do the work is in a sense a follow-up on last year's presentation. If folks, I see a lot of familiar faces, so I do think a lot of folks were here last year. The topic then was this slide called the death of NIM, which, as Jackie mentioned, bankers don't like that much. But the fundamental thesis, this slide is from last year, was that at the time, generative AI was this amazing magic tool that could read and write, but we and lots of other people were predicting that it would evolve into a magic tool that could actually do things, so-called agentic AI, and that would lead for consumers to the death of inertia, the death of the laziness that has kept retail banking in its place for so many years. So that happened, and I do think that a lot of those predictions are on their way to coming true. But since then, we've been focused on the other implications of this looming and now here future of agentic AI. And one of the biggest is that the scope of opportunity for founders has expanded dramatically. This is, in effect, the history of the opportunity for venture-backed founders. This is the tech industry, global IT spend, and the fact is, any way you slice it, if you look at all the big venture-backed wins over the past 40, 50 years, they've just been, what we call tech for tech. They've been more like pure technology companies, selling to CTOs, CIOs, CISOs, and nearly $6 trillion is not a bad starting point. Of course, the venture industry has grown as well to nearly $1 trillion, and myself, I don't love that ratio of $1 trillion worth of capital chasing an opportunity pool of $6 trillion, particularly when you factor in profitability and get to market cap. I don't love that ratio. But we do have some good news, which is that starting 6 or 7 years ago, a bunch of founders figured out something that people call embedded finance. And it dramatically expanded the revenue, profit, and market cap opportunity available to founders in fintech. And this is fundamentally, this whole presentation is majority a fintech story. So the companies, many of which Zach mentioned, the Brexes and the Ramps and the Revoluts and the Nubanks, Apple, companies like Bill.com, these are all software companies, of course, but at the end of the day, the monetization comes from payments, lending, and insurance. And so therefore, the available profit pool for all of tech expanded dramatically with this embedded finance motion. And we're here to submit today. I had to change the axis for this last bar, as you note, because the opportunity in services outside of and including financial services enabled by agentic AI is just simply that much bigger. We have a partial list here today, but you can see from the cumulative bar here of over 60 trillion, over 10x increase in the opportunity available to founders, more than half of it is financial services, starting with those embedded finance opportunities and then adding in everything else globally that the financial services industry does, which we submit can better be done by technology-led organizations run by dynamic founders, powered by agentic AI. On top of that, you see all of professional services, you see healthcare, you see education, you see, tech fits neatly in there in a really small way. Customer support, marketing, there's a lot of all other in here, but the fact is, 64% of the global GDP is services of one type or another, the vast majority of which are susceptible to founder-led companies leveraging agentic AI to produce disruptive economic outcomes and better experiences for customers.
So before we actually go into what does it mean to build these businesses, right? What does it mean to build a service-led business? We'll talk a little bit today about the examples we're seeing in the market, how we're seeing this across Bain Capital, the different types of financial structures that exist in these markets. We wanted to do a little bit of a recap, right? It's sometimes helpful in an AI innovation economy that's moving seemingly in weeks, months, and days, rather than in years, to look back to the beginning of 2023, which feels like eons ago, right? And we remember when we were sitting in our seats in early 2023, when the kind of the ChatGPT moment had happened, it had taken over the world, we saw a whole range of companies come up across, primarily at the application layer, across two primary markets, right? One is what you might call horizontal jobs, right? Jobs that we expect to be automated by AI, sales reps, customer success, designers, marketers, software developers, and then AI applications going after and selling into vertical markets, right? Law, accounting, education, architecture, and insurance. And just to kind of remember how crazy and different of a time that was, right? Copilot was a term that was kind of reinvented or reframed as tools for people to go become more efficient. And GPT wrapper, which I don't think we hear as much these days, was almost this derogatory term of a company that doesn't actually have a business model and is just building on top of the GPTs. So times have changed quite a bit since then. A question that we kind of asked ourselves all the time when we would look at companies at this point in time is and one of our basic assessment criteria was, is this company going to be excited about or nervous by OpenAI Demo Day? Right? Is this a company that's going to get better as the foundational model layer gets better, or will it get hurt as the foundational model layer gets better? That was actually probably 12 to 18 months ago, a relatively straightforward question to answer. Right? The models would get better. We saw application companies going and leveraging those models. Now it's becoming complicated. Right? It's become the capabilities are improving at such a dramatic rate that it's not even clear who is safe. Is anyone really safe at the end of the day? And so again, and kind of the final point that we wanted to make here in the retrospective is to do a look back at kind of what's happened over the past few years. Right? There was a series of conversations that have happened of predictions that happened a couple years ago. We wanted to do a kind of current state of affairs. And I'd say we generally at Bain have viewed this in three markets, or in three categories really. The first are the early winners, right? These are highly skilled teams, rapidly challenging incumbents with enterprise and bottom-up strategies. These are the horizontal and vertical strategies that are absolutely winning, right? Big names in these spaces on the job side, or maybe a Cursor or a Decagon. On the vertical market side, we have Rogo here, Harvey, Hebbia, a variety of companies that are actually growing at rates that we've never seen before. And I think if you look 2 years ago and ask the kind of consensus in the venture capital and founder community, people generally underestimated how much value was going to be accrued by the upstarts. Right? These companies are doing phenomenally well, and also capturing an absurd demand shock on the enterprise side. Right? People are actually willing to pay real money for this stuff. So that's the kind of current state of the early winners. The second are places where what we call the empire strikes back. Right? Places where there is a debate on is AI an enabling technology? Is it good for the incumbents? Is it a platform shift? Is it good for the upstarts? There are places where it's actually been pretty good for the incumbents. And there's been a variety of incumbents that have been able to implement AI very effectively to go enhance their products to go meet the market where it is and really hurt the upstart companies. There have been some cases where that's been more prominent, say in design software with the Figmas and Adobes of the world, in document processing with maybe Notion and Google Docs, and a variety of other markets. These are games that are still being played. The third market, which is actually what we want to talk about today, is what we call tough markets. Places where actually venture-backed founders and venture capitalists historically have just not played at all. Right? These are traditional service industries, right? What Matt was alluding to on the expansion of venture capital, places where we're just seeing entirely new classes and constructs of businesses that are coming to market right now.
So we have slides and slides, as you might imagine, describing different facets of this tough market question, and we use these to guide our efforts. But I've just picked out a couple here in the interest of time that are sort of themes, ways of slicing into this $60 trillion opportunity. One here is, over the last 40 years, there's been this inexorable trend. If you take any human activity, there's been a crop of software companies that jump up to try to serve it and create screens and workflows. We submit that there's a bunch of human activities that should never have been turned into software. This chart, which I love, is a survey of 15,000 business users. This is a net promoter score on the left-hand side from low to high. In the lower left-hand corner, people really hate this software. On the horizontal, you see, okay, so you hated it when you had vendor A, you switched to vendor B. Did you get happier? On the right, yeah, I did get happier. Maybe I had the wrong vendor. Again, lower left, it's like, nope, still hate it so much. So this lower left-hand category to us, I think we made a mistake turning this stuff into software. It used to be that when you thought about, I'll pick two, which are really fintech applications, human capital management and enterprise resource planning. It used to be that when you wanted these jobs done, you would have a service firm made up of human beings who would do this work either internally or externally around human capital, around the benefits function, around the payroll function, around the needs of employees and the planning of an organization relative to those employees. And similarly, the ERP, this is the general ledger, this is accounts receivable, accounts payable, treasury management is my favorite one. These all used to be done 50 years ago by teams of skilled people. And then we had this notion that this could all be done by software, and you have huge companies like Oracle and SAP. These are despised companies. I mean, this has not worked, this human experiment. And that fintech opportunity to take all of those functions, where right now you've got software companies and the ones founded by recent technology-led founders are better, for sure, than the legacy ones. But we submit that in the future, we're not going to be comparing, Intuit to Sage to NetSuite. We're going to be having those jobs done by agents, managed internally or externally. And that'll be true around all of those functions I just listed. Think about treasury management, this fintech category where the average NPS is in the single digits and the majority of the vendors have negative NPS. It's just not a software job. It's a service. And it's less interesting to build a services company when you have a team of people doing the work, but when you have a team of agents doing the work, and you can generate 60 to 80% gross margins, and it delights the customer, and is extremely sticky, we are going to have a legitimization of services-based companies coming into categories that had historically been tried and failed to be served by software companies. So that's one theme we look at. Another one, again, of many is just simply to compare in a given vertical or a given horizontal the size of the software opportunity to the size of the service itself. Some of these bubbles match up with each other. Legal software is $27 billion, not nothing. Legal services, just in the United States, $350 billion. Globally, it's $800 billion. And this is true for insurance brokers. I mean, $500 billion, again, just here in the United States. The bubble was too small to fit onto the chart. I mean, it is an irrelevant category, selling software to insurance brokers. There are two companies that do it, and together their revenue is less than $1 billion, Applied Systems and Vertafore. So in every one of these cases, particularly the ones in and around financial services, if you're looking at the revenue or the profit or the market cap opportunity, you would much rather be the service provider than selling technology to the service provider. And this is the other, again, early and sort of controversial point, which is that it's not obvious that the venture model is the right way to serve these opportunities. What's obvious to me is that it is the founder model that's the right way to tackle these things. This is all great, great news for the most important constituency in the room, which is the founder. I think it's less obvious that this actually serves the average venture firm. There's a lot going on this slide. By the way, when I say we've been at this for years on this slide, the we here is founder-led companies. These happen to be companies we've invested in because we know them best, but across this 2x2, the winners have been founder-led companies, and that's the takeaway. There are many different styles of company building represented here. On the upper left, this is the work that venture capitalists have done for years. You're building a startup that's building technology. It's a vendor. And there have been, again, the vast majority of the huge success stories in venture capital have been in this bucket, building software companies to sell into an industry or sell to a horizontal, started by founders from scratch, backed by venture capitalists. And again, proud tradition. We continue to do this all day long as an industry, as a venture industry. This upper right category, you've probably been hearing a lot about, which is same method of company building, venture capital firm, founder, let's start a company. But again, we just have our examples here, starting a law firm, starting a outsourced regulatory compliance service, we're going to talk a little bit about reserve on the next slide, just as one concrete example, but starting an insurance claims TPA or a boon, like a retirement TPA. There are 30 companies within 2 miles of where we are today that are starting accounting firms, particularly around financial services and all of the functions that serve financial firms or CFOs, CHROs, and general counsels. People are realizing that, again, based on the market size, based on the low NPS of software and many other factors, that the right way to serve these markets potentially is not to try to help the incumbents do better, but to displace the incumbents entirely. Founders, as usual, figure that out first. Venture firms, as usual, follow whatever the founders do. And so here we are in the upper right-hand corner for the first time in my long career, starting things like law firms. And then the bottom right, we've only done one of these out of the ventures group, but WeBank Capital have done a bunch of these. And again, the industry is starting to do private equity style transactions with technology savvy founders who are realizing that the company building method that works best might be going to buy something traditional and transform it. Or going to buy one thing and then buy many things in a high velocity acquisition model, leveraging agentic AI at the core to perform the transformational disruption of changing the game in that particular industry. And so this double vector shift from, we VCs and generally the founders we work with, we start companies from scratch and we build vendors that help incumbents solve problems, to actually, let's disrupt the incumbents entirely, to, and by the way, we might want to start by buying something. It's in its infancy. It's happened in a couple handfuls of cases, but the momentum is enormous. And often you could look at when things pick up steam in asset management, it's because, you get a chance to invest more money and that's a good thing. But this actually has very strong economic logic. And when we talk to LPs, who are usually very skeptical of innovations that venture capital firms bring forward, they get this. They're like, oh, wait, so your average entry EBITDA multiple is 8? That sounds better than an average revenue multiple of 100. So let's talk more about this. So, Reserve is an example, going back 3 years, at the very beginning of generative AI, forget about agentic AI, we had this idea that insurance claims was one of those reading and writing opportunities. You sit there as a claims adjuster and you read the claim report and you read the policy and you synthesize that into a loss adjustment report. Felt like something ChatGPT could be useful on. So we incubated this company and then recruited these 2 co-founders. And the fastest growing company we've ever had. This is their second full year revenue. They'll do well north of $50 million in revenue. And it's just like Ron was saying, one of these class of companies that is just clearly, empirically, so much better than the competition. And in this case, at twice the gross margins and improving. Very interesting and important proof of concept for us as a firm. And there are many other similar cases where you have founders that are taking these activities historically kind of taboo in company building circles because of the exit multiples, because of the inherent historical gross margins, and turning it into an amazing opportunity. Yep. Just quickly on how we do this, Ron.
Yeah, one of the things that is really interesting as you think about these different prosecution strategies is that starting a company is very different. Right? Historically, if you started a venture-backed startup, what would you go do? You'd go talk to a bunch of potential buyers, understand their pain points, and then figure out, okay, kind of where do I slot in? What can I potentially replace? Here, because the range of prosecution opportunities has increased dramatically, we've actually found it most helpful to go market first, right? And go from a macro level, where are the parts of the world where we think AI is going to move the needle the most? How are we going to go look at that? We look at, more private equity style variables, wage growth, labor shortages, market fragmentation, where we think there's a product improvement opportunity, where we think there's an opportunity for internal margin expansion. And then only from there, we try to figure out, okay, what's the right prosecution strategy here, right? Is this the type of place where a net new startup company makes sense, a net new tech company makes sense? a net new service firm, a private equity roll-up, a buyout, or something in between. And then from there, you have a different ballgame and how you go. There's different vectors that go from there in terms of how you go build it, depending on your prosecution strategy, right? If you're going on a de novo on a build the company model, you're starting to think about how do I structure an unfair distribution advantage for my company, right? In most of these traditional service firms, it's actually distribution and domain expertise that are much more of the scarce assets than coming up with a new technological advantage. Right, and so that's a lot of what we spend our time thinking about. And then similarly, when you're going buying an asset to start off, there are a bunch of different types of assets that you might be able to go buy. Are you buying a service company that has already been tech-enabled? Are you buying a non-tech-enabled service company? Are you buying a data asset? Right? Are you buying a service company for its historical data to go train your model on, or something else? And then the final note here is that who is on the team has also changed pretty dramatically. Right? If you think of the history of venture-backed startups, we typically imagine kind of 2, 3, 4 very sharp engineers and technical co-founders. We're actually seeing much wider founding teams. We're definitely seeing the engineering and product discipline as a core discipline here. We're seeing far more founders who come from the domain, who come from traditional operational backgrounds, who come from even private equity backgrounds, people who we don't typically see coming into venture capital contexts. And it's oftentimes that the best companies or the most interesting opportunities are actually the combination of all of those. Right, are these people that historically haven't really known each other and haven't really spoken to each other coming into a room and say, hey, we actually each are bringing something to the table here. And I think that one of the things that will, the next slide before the end, that we'll leave it here is that this is a constantly changing puck, right? If we started off I started off the talk, or started off my portion on looking back 2 years ago and identifying how different the market was. We're still in an actively changing ballgame where we really don't know what's going to happen, right? And we're actually seeing in every single one of these markets, there are different winners that are coming up, right? You might argue that the labs are going to win, AGI is getting better every day, most of these things are going to get commoditized, and and the value is going to accrue to the model layer. We're seeing a whole bunch of vertical apps that are growing faster and more aggressively than we've ever seen before. They're easier to build, the growth is kind of continuing to be exponential. You might argue that the hard part of this stuff is actually the change management. It's really hard to go into these more traditional companies and actually work with these people, understand the niche workflows, change culture, change behavior, things that private equity has historically dealt with. It might be that that's where the value accrues. Or you might argue that the service providers are who wins. Right? It turns out that the relationships are the ones that matter. The brands, the history, the reputations of the firms are the ones that end up accruing value. And in each given market, we're actually seeing different outcomes even right now, and it will probably continue to change. And we'll leave with just a final thought. There's a common kind of sentiment in Silicon Valley that the next Google won't look like Google, like the next OpenAI won't look like OpenAI. And this is especially one of those markets. Right? In a world where AI capabilities are getting better, maybe distribution and domain expertise are mattering more, financial structures are becoming broader and more confusing, it's likely at all that the next OpenAI or the next Google might not even look like a tech company. Thank you so much.
I'll just end by saying, Eric asked me when he saw the deck, are you sure this is a fintech talk?
Yeah.
It's not a fintech talk, it's a financial services talk. I think what I'm tired, 25 years of investing in fintech, I want to talk about financial services. I'm tired of nibbling around the edges of this $33 trillion industry. And I think it's time for founders to also embrace that. This isn't about incremental change, it isn't about making incumbents better. It's about fundamentally changing the experience for the better for customers. And the only way to do that is take them head on. So we're really excited to join with you in that journey. Thank you.